Okay, good day, everybody. This is Jim Kinney for OptionProfessor.com. This is a special report midweek. I'll have a regular report on Friday. And today, of course, would be the 12th of June, 2019. As I start every broadcast to disclose that past performance is not necessarily indicative of future results, and short-term trading and option trading involves substantial risk of loss. You should be consulting with your clearing firm, your broker, your financial advisor, your good common sense to see if any type of trading is appropriate for your circumstances. Today, of course, as always, I just give you my opinions and my views. New listeners, I would like to just introduce myself. I'm Jim Kinney, graduate of Boston College, been in the investment arena for decades, and I've conducted hundreds and hundreds of seminars throughout the nation on the uses and the risks of options, from the use of using them for limited risk speculation, as well as cash flow strategies like covered call writing and hedging tactics, which is what I'm going to be talking about here today. Okay. The reason I'm doing this special broadcast is the market did go up towards that 29.50 area. Again, those who've been listening to me, I've been telling you my opinion has been when we hit the 23.50, we were way underneath the 200-day average, which was 27.50. I thought we'd snap back towards that, which we did. We went through that, and I upped my targets to the all-time highs around 29.50 with a possible overshoot of 3,100. Well, we hit the bottom area of my sell zone, and then we've turned down, and then we've come back up towards it again, and then we're turning down. So there seems to be legitimate resistance at the bottom of my sell zone, which is 29.50, which is why I'm talking to you today, particularly about two sectors that have been very good momentum trades and have had very good advances. But of course, every advance comes to some type of at least a temporary stop. And I think it's possible that that could be happening here. So that's why I'm giving the broadcast to discuss the concept of hedging. Let's take a look here well, I'm going to go over the general market right now so you guys get an overflow of what's really going on and where my opinion's coming from. Um, One thing I did note here, I heard on the TV, financial TV, that the Fed, once they stop doing tightening, within a year, they tend to do easing. And basically, the only time they didn't do it within the year in the last six times they did the cycle was in 2007, and the results of that aftermath wasn't very good. So I would say that the likelihood of some type of rate cut has been increased unless the numbers change dramatically, particularly on inflation. With the Chinese tariffs, some of those products are just beginning to hit shore at the higher price. So the higher prices of those items could hit the inflation numbers in the months ahead. Today's inflation number was pretty benign. Okay, but again, the last two times they went into a tightening cycle, 2007 started in 9/18, and 2001, where it started on January 3rd. 1 month returns afterwards. In '07 was positive 1.4, and in '01 was positive zero point 0.1. But within the year, the next year, the effect was minus 20% in '07 and minus 14% in '01 after they initially started their easing cycle. So, with that as a backdrop, people are looking at 1995 and 1998. We're on a 1, 3, and a 1 month, 3 month, and a 1 year basis. When they started their easing cycles, stocks did very, very well on a 1, 3 month and 1 year basis. So everyone's hanging their hat that this is going to be like 95, 98, not like the last two cycles. We'll have to see who's accurate on that. At any rate, I was looking at some of the situations here, but I'm going to give you a little background first, okay? All right. SPX, let's get the symbol up there. There we go. SPX. And we'll see what the S&P 500 is doing right now. Okay, right now it's down about 4 points, but you can see had a big drop there down to 27.50 about a week or so ago, and then a big bam up to the upside. But you see that resistance area right in the 2900 to 2950 area still hasn't been able to take that out. We're now trading down towards 2880. Tuesday, sometimes a reversal day. We saw that yesterday. Thursday is sometimes a reversal day. We'll have to see what tomorrow brings. But the things that have made me concerned, look how far back we came back on the S&P. Now let's look at a couple of other indexes that I watch, which is the transportation average. And you may see a little bit of a lag there. So yeah, you can see the rebound here has been much, much less than on the S&P, and I don't see that as bullish. And then basically the Russell. These guys have been pretty good indicators to me. That's why I kind of keep an eye on them. The Russell is 2,000 stocks, mostly domestic and smaller in nature. And the Russell, if it'll be kind enough to come up after I click it here, you can see that's also lagging. You know, see that's the highs up here, had trouble up here, now we're lagging. Now you start getting about 1550, 1600, that's obviously going to change your tune, right? But right now that's not happening. So you have to be concerned about what's happening now, not only what might happen. Okay, so let's take a look at something that I wanted to bring to your attention, which is the two types of sectors that I think there could be some vulnerability in, or at least some stabilization in, because they've run up so high. Let's take a look at them. One is the cloud companies, and the other is the payment processing companies. So let's take a look here, and we'll start out with Adobe, and we'll analyze it a little bit and get an idea of what it looks like. Excuse me. You can see that it had a very big run up, right? And you can see that it went up to 290, came back down to 260, came back up, didn't take out 290, and now it has started to sell off a little bit. The volume has not been that tremendous on the rebound, as you can see down the bottom. And so basically, the thought would be, and the PE ratio is at 51 according to the screen, so it's not a cheap stock, but a lot of these companies do trade at high multiples. At any rate, somebody who might have been in there at 200 that now sees it at 290 area, might consider protecting some of those gains. A couple of different strategies that one might consider would be buying a put, and that's where you buy the right to sell at a certain price for a certain period of time. If you're up $90 or $80 on a stock and you put up $5 to hedge it, at least if it starts to roll over and if it were to take out 260, you would have protected your equity while it was still up. Now, if the market doesn't drop, you lose the put premium. Not unlike when you buy car insurance for 6 months. If you don't get into an accident, you will lose the premium. And if you do get in an accident, you'll exercise your right to have insurance. Here, if it goes down, you could obviously exercise your right to sell at the striking price, whichever one you pick. So a married put would be where you take a put position against your stock using some of that capital gain to pay for it. The other type of strategy would be a collar strategy. And that's where you might sell the 290 or the 300 call, take the premium, and then buy a put underneath. That puts a bracket on your equity, which means what? Which means it has upside potential to the strike price that you choose on the call, and it's got downside risk that is limited to where the put premium, where the striking price is on the put. So it gives you a little bit of a window of risk reward that's set up. And then another way to do things would be you would liquidate some stock and then replace it with a limited risk call, maybe at something like whatever you choose. But that gives you the right to buy. But the premium might only be $5 or $6 or $7, whatever you choose, or even less if you're going to do a short-term deal. And basically, if it goes down, you'll lose the premium, but all that other money that you sold out on will be in your pocket. So replacement calls, married puts, and collars are three ways to approach this type of a thing. Now let's take a look at Adobe on a situation here now. We've got some of the tail of the tape here. The volume on Adobe has been drying up. Why is that? Well, I don't know why it is, but I can tell you the 50-day moving average is 2.2 million shares a day, ballpark, and then 3.3 million on a 200-day. So it's obviously been skinny on the advance. Second thing is the high was made at 291 on April 29th. So we've been over a month and a half almost where we haven't made a new high. And then, of course, the moving averages are still positive, but the 254 is pretty far under the 290 that it hit That's $40 above it almost. That's a pretty, a little bit overbought, and we're still 20 bucks, 25 bucks above it now. So adding that all together, that's just something that I was looking at as a consideration, something that you might consider if you're looking at some of these things. And if you think that the 2900 area is not going to get taken out on the S&P, and if you think their correction could occur. If you think those type of things, this is some way of trying to take some positive steps to protect your equity. All right, let's turn to another one here. And this one was in the news here recently, and it is Salesforce. And let's see what Salesforce is doing here today. Salesforce is up about $1, but as you can see, it went up towards that high area of 165 area where the 52-week high is a few times, and it just tried to go up there now, and then it has a pullback. Now, they got involved with Tableau with an all-stock deal, and some people are viewing that as a very positive on Salesforce, that the company that acquired would accept stock rather than cash. And so some people are finding it very bullish, and others are saying that the P ratio over 100 and the company's performance, while it has been very good, when you're at 101 P ratio, it has to be darn good because that's a high evaluation. So if you thought that this 170 area won't be getting taken out for a while, and you got into it at a lower price of 100 or 120, obviously you might want to protect some of those gains. Again, that might be something to consider. Let's take a look at the internals on that a little bit and see if there's anything that could give us a little bit of a hint on what's going on there. Short interest is not very big, so you can't count on a lot of short covering. The volume, again, it has dried up a little bit in the last 50-day average versus the 200-day. And basically, it made its high on same day, April 29th, which coincidentally, a lot of these cloud stocks may have made their high at that time, and they haven't taken out their high in a while. And so, again, nothing grows to the sky, and it could be a situation where there could be some ways or moderate activity. Be careful for tomorrow, because sometimes you get a reversal back to the upside, and if it does get a reversal back to the upside, see how it does in the 155 to 165 region. See if it's going to fail up there or not. But this would be the neighborhood to try to protect your equity, not after or if it does a decline. All right, give it another cloud one here, and OKTA. And on this one here, another one that had a very big run up from 41 bucks to 133. I guess that's a pretty big run up. And it has come off just a little bit. Again, this is a company that, obviously people are very much betting on the future. And again, let's take a look at the internals here, because it might give us a little bit of a tip of what's going on. But it obviously has had a very big run up. And so things that have a big run up, obviously are great, but they don't last forever. Short interest here, pretty big, right? Almost 10% short interest. So that's probably fueled this rally a little bit. The volume is pretty flat, on a 50-day and a 200-day. So there's nothing telling me there. But I do see the 200-day moving average at 77. So let me help you with some math on that one. You've got 128 as the current price and 77 as the 200-day moving average. So you got a $51 premium, or in terms of percentages, you are now 66% above the 200-day moving average on a company that looks like it's losing money. So obviously, that's a very much of a buy for the future, buy for whatever is going to be happening down the road, rather than the current circumstance. My feeling is that, again, this thing just made a high here on June 10th. So it is this week it's made its high. So just monitor it a little bit, maybe, huh? And if you don't see it continuing to make new highs, and you want to try to do something to protect some of that profit, again, the three tactics that I mentioned to consider and price out and see if it makes any sense would be the married put, the collar strategy, and the replacement calls. If you have any questions on this type of thing and it's confusing to you and you'd like some explanation, you obviously can turn to your brokerage firm and ask them, or your financial advisor. Or if you'd like to ask me a question, you simply shoot me an email at optionprofessor, OPTIONPROFESSOR @gmail.com. I'd be more than happy to try to help you. All right, so let's turn to another one here. and we're going to look at NOW. Okay, let's get the right symbol up here and take a look. There we go, NOW. All right, that company also big move, right? 147 up to 281. Now it's at 269. It's going up a little bit today, but it did come off the highs here pretty good, and that does look like a little bit of a double top up there. So, what's going on here? Let's go take a look at the internals on ServiceNow and see if in fact there's something going on here. Again, this is another one that is very much betting on the future. And again, if we don't get through 29.50 on the S&P, if things turn a little bit south and we do break under 27.75 on the S&P, which is around the 200-day moving average, I would think that some of these might come into play on the downside a little bit. There's a big gap on the chart right there between 195 and 210, and did try to fill that gap right there. But let's see what's going on here and get an idea what the volume's doing, get the idea what the moving averages are doing. And here you go. You're at 212 on the 200-day average. You've been as high as 281 on May 16th. And so we've been about a month since we made a new high. And so from where we are now, which is around 270, and where the 200-day average is now, you are sitting at a premium of about 27% above the 200-day moving average. And you're seeing a volume that is less on a 50-day basis than on a 200-day basis. So is there a potential for some sideways or selling off here if the market overall runs into some headwinds here? You've got this G7 G20 meeting. There seems to be some aggressive talk regarding tariffs if he doesn't show up and this type of thing. So yeah, a lot of volatility could be ahead one way or the other. Monitor it though and see what you think. And I just wanted to bring it to your attention because these things have had a big run and they seem to have stopped making new highs. And of course, sometimes that's a precursor to consolidation or a pullback, particularly if they're extended. Okay, do I have anything else here for you? TWLO. Let's try to take a look at Twilio and see what they look like. Because these things have had big runs, right? All right. So where are they? Where they used to be at 60, now they went to 150. Now they're currently 141. You can see that high point at 150 here, surrounded by lower high points. So again, with the valuation that's not even there because it's obviously a futuristic bet. Let's take a look at what the internals look like as far as volume and moving averages. And let's see here. Hold on. Put the thing back up here. TWLO. And get you the internals here. Okay, and we're back at it, and it's 142 now, and you can see the 52 week low. 52 week is 53, so we have a triple here. And let's take a look at what it looks like here. Okay, so you got short interest at 9%. That's pretty high short interest. Again, that explains some of the rally maybe as well. The moving average is at 103. You're at 142. So 142 minus your 103. Where is it at versus the averages? And it is at about a 39% or so premium to the 200-day moving average. My view is that's a little bit on the extended side. So a discussion about hedging or protecting your gains a little bit doesn't seem to be out of order. Again, nobody knows where these prices go. So it could be going to 200 tomorrow, or it could be having a correction, but real money is real money, and speculation is speculation. With regards to the volume, pretty flat. So, nothing really telling you much there. But, when you get 20, 30, 40, 50, 60% above the 200-day average, my experience is that in some cases you do get a pullback. Not always, but sometimes you get a little bit of a pullback. And again, hedging or protecting your equity when it's way up makes more sense than after it's come down, right? All right, let's look at some of the payment companies here. They had been going up quite a bit too. And so let's see what Visa is doing right now. And Visa today is up a little bit. It hit 172. So this is a neighborhood here because it is obviously gone up from 120 to 172. P ratio 36, according to my screen. If the market is not going to get through 2900, 2950, if the market is going to take out 2775 on a correction, and again, we'll probably know that in the next 2 to 3 weeks at the latest, after this meeting at the latest. But this is the time to start looking into or discussing the concept. And so you made the high here just this week, right? So obviously it's very close to its all-time high. Where are we as far as the moving average is concerned? This one is not tremendously overbought. 170 minus 146 is not too bad. It is, in terms of overdone, about 16%. But this is a mammoth company. Look how many, $372 billion company. So that kind of company that is 16% above its 200-day average. And look at the volume. 6.7 million shares on a 50-day basis, 8.9 on a 200-day. So it's making this rally on lower volume. So again, I don't think I'm out of school to at least mention the concept of hedging and mention the concept of investigating it at this point, and see if you, in your opinion, think it's appropriate. But the numbers there, are a little extended, and if we're going to break down, they're very extended. So keep an eye on it. With regards to another one is MasterCard, of course. And on MasterCard, it is currently trading at trading at 262, and it made its high up at 269 probably this week, and it's coming off a little bit. P ratio there a little on the rich side, maybe no dividend to speak of. And how far has it come? 171 to 269 is a pretty good run. So let's take a look at the internals on it and see what we can find. Okay, what we find here is that short interest is nothing to speak of. And then we're looking at the moving average at 217. And today we're at, where are we at exactly here? 262. So 262 minus your 216. Divided into your 216, and there you're 21% over the 200-day average, which in my view, in my opinion, is a little bit extended. So this would be something that would be vulnerable if the market is going to roll over, I think. Now, again, the volume here a little lighter than it is on a 200-day basis, and basically the high was made this week. So these payment processors made highs this week. The question is, are they going to hold their highs? And that's why if I own them, I would be watching them, and I would be considering doing something to protect my gains if, in fact, I thought that the market might roll over. Last one on the payment processors is going to be the PayPal. And on PayPal, what are you looking at? Let's see. Let's get MasterCard off of there. Hold on here. 1, 2. And then hit it, and then we're okay. Okay, PayPal. And on PayPal, you are looking at a company that obviously also went way up here, 117. And now it's at 114. Look at the low is 74. But if you look back further, I mean, it's had a pretty good run here. Now, what does it look like? This one has a 61 P ratio, so that doesn't sound like an inexpensive company valuation-wise. But of course, there's big futures to these companies that have these P ratios, and that's what people are betting on. Okay, so where are we here? We are at a high that was made this week at 117, and we're at a 93 on the 200 average. And so you are looking at a premium of what about 20 bucks? Yep. And so 20 divided into 93 gives me the premium, and that gives me a number of 21%. So you're 21% above the 200-day average. You're at the all-time high. We tried to bang through 2,900, 2,950. We don't seem like we're doing a great job of it. That could change tomorrow because Thursday is sometimes a reversal day. But if it doesn't change and we go and we have a poor result out of the G20 situation, then again, there can be a change in the climate. And if there's a change in the climate, these ones that are way above their 200-day averages, I think would be candidates that could possibly get some profit taking in there. So that's why I wanted to bring those to your attention. Now, there is a couple of Chinese companies I wanted to bring to your attention. They also have payment situations going that they're involved in. But there's a lot of noise coming out of China that they could also have some contraction in their GDP. And so they could need a lot of stimulus, and they want to get their domestic thing going. But let's take a look at BABA, and let's see if there's anything going on there that might be worthwhile. Okay. I thought it was a very good bargain down at 130 area, because then the 200-day average was up around 170. So obviously, when you're down at 130 and the 200-day average is 170, I'm looking for something that's going to go back toward it. Now let's see what it looks like if we shape it up looking at the numbers. To me, looking at the chart, if it can get above 170, close that gap, that would be back on the bicycle. Let's see what the moving averages are telling us. P ratio looks pretty reasonable compared to others anyway. And that 150 mark looks like some support, no doubt. So let's take a look at what that looks like. Yeah, you got the moving averages in a positive mode, but the market's underneath its moving average because it recently just dropped from 200 to 150. Is that drop a buying opportunity? Again, getting above 162, which is the 200-day average, would be very helpful. Getting above 170, which is the 50-day average, would put these inverted averages back in the positive sign, because you want them above 170 and 162 if you want these averages to continue to matriculate to the upside. You can't have these averages matriculate to the upside trading underneath both of them. That's the danger sign right now. Obviously, a line in the sand here might be the 150 mark. But again, with all the news risk and all that type of stuff going on, it's a little bit of a tough time. But I'll tell you, on a long-term basis, this is a company that has payment processing over there, and it is obviously a huge company at 420 billion. And so if there's a future in China, there's got to be a future for BABA. The other one is Tencent, and let's see what you got here. TC. EHY. They got a thing called WeChat, which is a very popular thing over there for trying to do payment processing as well. And so Tencent Holdings here is looking at like 42 on this symbol here. And let's take a look at what the internals look like on it. This thing hasn't moved very much. It's in a range 32.52, so it's not as volatile as BABA. And again, it looks like 40 is a big number for that one to hold on to right now. And let's see, again, though, $416 billion company. These are definitely the heavyweights over there. And 42.46. So, seem like BABA. Get above the 200-day, that would be a good sign. Get above the 50-day, that'd be a good sign. But the volume drying up here a little bit is not that great, unless the volume's drying up because the selling has abated and that the volume is going to pick up now and it's going to be buy volume. Again, get above 42, get above 46, that would get me much more interested in this, because again, going back towards 50 or 60, you have to go through these numbers to get there, right? And again, they are inverted to the upside, which is a positive relationship, but you need to get the market above those two numbers to make sure that those two numbers will continue to rise, because they can't do that if the numbers they start feeding in are much less than the numbers they are now, using common sense on the moving average. Okay, well, I did want to come to you here before the end of the week. Thursday again, tomorrow could be a very volatile day because sometimes it's a reversal day one way or the other. But again, we did enter that sell zone of 2,900, 2,950. That's the bottom of my red zone as far as the market is concerned. My red zone for selling was going to be 2,950 to 3,100, and we did hit the bottom of the red zone and turned down. So I thought it would be worthwhile to give you this information, talk a little bit about how to hedge, and again, hedging through married puts, hedging through collar strategies, and hedging through the replacement calls. If you have questions on this, again, you guys got firms you work with, but if you'd like to talk to me directly, simply shoot me an email. Option Professor, OPTION, Professor, PROFESSOR at gmail.com, and basically you're in. You can shoot me an email anytime you'd like. Be love to give you a hand if I could. Again, this is Jim speaking to you on a Wednesday with a special report, and I'll be with you on Friday for my regular report. If you have friends or associates that are interested in learning more and would like to take advantage of the information that I try to provide and put it into their mix of what they do to try to make up their mind on things, feel free to give them the website optionprofessor.com, and you can get the link, and they can get the link so they can join in for the next broadcast coming up this Friday. Until then, good luck and good trading. Keep educating yourself, and be careful out there as we go into this period of time ahead with the meeting. It could be an increased volatility period. Have a good day.